Top 10 investments everyone should make in their 20s and 30s. If you are in your 20s or 30s and intend to have a comfortable retirement, no matter how far away it may seem, you might not have many options, but one of the best is to invest early. To live a comfortable life, it's obvious that you need a substantial amount of wealth. And one of the best ways to do this, especially for the working class, is to invest your money. You will be much richer if you start investing early. Here's a great example. Let's say you decide to start investing $500 a month and earn an investment return of 8%. If you start at 25 and continue with this strategy until you're 60, you will have $2.16 million at retirement. But if you start investing at 40 instead of 25, you will only have $341,000. Of course, this simple example is not news, and it depends on an investment that yields an 8% compounded return year after year, without considering inflation. But as I said, it's not news, and I bet you've probably heard it many times before. For most people, this is still the best way to grow your wealth and ensure you have a nice reserve to spend in lean years. In short, by starting early, you set yourself up for success. In today's Practical Wisdom video, we will examine some of the most important assets and investment decisions you can make while young. Let's start, okay? On the screen, without any order of importance, are the investments I will discuss in this video. So, let's start with the first one. 1. Index funds. Stocks are one of the best investments you can make before you turn 40. Although they can have a very high risk, the returns are among the highest. When you start your investment journey, you have plenty of time to make and learn from mistakes, but you should always make smart and calculated investments. Stocks have an average return rate of 10% based on the S&P 500 index as a benchmark. The truth is that not many investments will have such a high return rate. While building your portfolio of index funds, consider adding bonds as well. Although bonds may have the lowest return rate, they are the safest. You need to ensure that your portfolio has about 10–20% of bonds. This ensures that your investment is safer. Additionally, you might add to the percentage and adjust it according to your risk tolerance. Recently, crypto index funds have been introduced. Although they have not been fully tested, they seem quite promising. Current return rates vary from 10 to 15%, which is significantly high. But as the return rate increases, so does the risk. A great advantage of index funds is that they have low fees. The lower the fees, the higher the returns. Another advantage of index funds, besides diversification, is that many index funds have low fees. Investment fees will quickly reduce your returns, so you'll want to avoid them as much as possible. When you buy index funds, make sure to pay attention to the tax implications as well. 2. Real estate. You can hardly go wrong with real estate. Real estate is one of the best assets for multiple reasons. First, there is almost always a deficit in the real estate sector, and real estate assets almost always increase in value. The first step in real estate investment is buying a home. Owning residential property reduces expenses, such as rent. Once you own your home, you can consider building other commercial properties. These could be multi-unit homes, townhouses, offices, and other properties. However, if you are not able to invest directly in the real estate market, there are other options available. There are various crowdfunding platforms where you can invest as little as $500. The money invested would then be collectively invested in real estate properties along with contributions from other investors. These investments are known as REITs, real estate investment trusts. 3. Education. Statistics state that your 20s are the best time to study. According to research, your 20s and early 30s are the easiest period to acquire new knowledge. Therefore, it might be the best time to get that extra degree. Acquiring an education is important because it can prepare you for professional success. However, you must understand that not all education or learning is an asset. While doing so, be careful because part of the learning can be defined as a hobby and probably cannot be monetized. If you want to invest in education, start by looking for careers that suit you and can lead you to success. This might also be the best time to improve your financial literacy. 4. Startup business. Invest in a startup business when you are young. Why? With a business, the returns are unlimited. You will have the ability to earn as much as possible, with an unlimited ROI. Another investment you should make when you're in your 20s is a startup business. The opportunity for an explosive ROI is incredible. Even if it's not the next Amazon, investing in a business when you're young can lead to incredible returns. You don't necessarily have to start the business yourself. You can invest in other people's businesses in exchange for shares in their business. For example, you could be an angel investor, and this is a great option if you know the founder. Your investment can be in the form of a convertible note, which means it could turn into a loan if a specific criterion is met. The other way is through crowdfunding. There are several crowdfunding sites with incredible startups that have high potential. Before investing in a company, make sure to read thoroughly about the founder and understand the story behind the company. Choose companies that have a solid plot and are backed by founders who have some form of education, experience, or training in the business sector. The other way is through collaboration with a venture capital fund. You can become an accredited investor and proceed to become a venture capitalist. However, these funds require a minimum investment amount and have rigorous requirements. 5. Treasury bills. Treasury bills are necessary investments for every investor at any age. There is no better time to regularly buy treasury bills than when you are young. Treasury bills are short-term debt instruments guaranteed by the government, issued to finance spending and control the money supply. Treasury bills have 3 maturities: 90 days, 182 days, and 364 days. Everyone has bills to pay, whether it's tuition fees, rent, or even professional exams. You can easily invest the money you have on hand in treasury bills and cash out when the bills are due. This falls under the financial concept of asset and liability matching, which involves buying an asset to finance the payment of a future liability. Treasury bills are completely risk-free, so your returns are guaranteed, unlike other investment options. Additionally, the returns are quite good, so why not invest in them? 6. Growth stocks and dividend stocks. We've made it clear that being in your 20s and 30s is an opportunity to make risky bets because if you lose your money at this stage, you still have time to recover. So, investing in stocks offers an excellent opportunity to invest part of your money in a high-risk, high-return venture. Growth stocks are simply stocks that are expected to grow at rates significantly higher than the industry average. These stocks generate positive cash flows and more sustainable revenues than their counterparts. Dividend stocks, on the other hand, are usually stocks of financially stable and mature companies, which means the stock prices are less volatile than growth stocks. Dividend stocks should be included in your portfolio at a young age. They offer opportunities to earn income consistently over a long period, provided the companies continue to perform well. 7. Exchange-traded funds. Now let's look at ETFs, which are very similar to the index funds we talked about earlier. ETFs are baskets of securities with multiple assets like stocks, bonds, and gold, making them similar to index funds. They are traded like stocks, which means investors can buy and sell shares on the stock exchange. Their versatility makes them valuable tools for investing in broad market indexes like the S&P 500 or in sectors, such as technology or health, and even subsectors, such as social media or robotics. Some examples of ETFs are the Schwab US Large Cap ETF, the Global X Robotics and Artificial Intelligence ETF, and the iShares Global Clean Energy ETF. 8. Commodities in economics. A commodity is an economic good, usually a resource, that has full or substantial fungibility. That is, the market treats instances of the good as equivalent or nearly so, without regard to who produced them. There are several ways to invest in this. The first is to purchase variable quantities of physical commodities, such as precious metal bullion. Investors can also invest through the use of futures contracts or exchange-traded products, known as ETPs, that directly track a specific commodity index. These are highly volatile and complex investments, generally recommended only for experienced investors. Another way to gain exposure to commodities is through mutual funds that invest in commodity-related activities. For example, an oil and gas fund would hold stocks issued by companies involved in exploration, refining, storage, and distribution of energy. The advantages of investing in commodities are portfolio diversification, potential returns, and a potential hedge against inflation. Additionally, commodities have shown the strongest performance during periods of inflation, making them one of the best assets to own. 9. Annuities. An annuity is a contract between you and an insurance company where the company promises to make periodic payments to you, starting now or at a future time. You purchase an annuity with a single payment or a series of payments called premiums. Some annuity contracts provide a way to save for retirement. Others can turn your savings into a retirement income stream. Others do both. If you use an annuity as a savings vehicle and the insurance company delays your payment to the future, you have a deferred annuity. On the other hand, if you use the annuity to create a source of retirement income and your payments start immediately, you have an immediate annuity. The two most common types of annuities are fixed and variable. There is also a hybrid called an indexed annuity, also known as an equity indexed annuity or a fixed index annuity. Annuities are often products that investors consider when planning for retirement, so it's worth understanding them. They are also often marketed as tax-deferred savings products. However, annuities have various fees and expenses, such as surrender charges, mortality and expense risk charges, and administrative fees and expenses. Annuities can also have high fees, reaching 7% or more. 10. Cryptocurrencies and initial coin offerings. It is only recently that cryptocurrencies and ICOs have piqued the interest of traditional older investors. However, with billions of dollars raised in ICO funding and over 1,000 different cryptocurrencies currently available, these rapidly evolving markets are enticing for investors. It is also difficult for most individual investors to make sense of these complex investment products and determine their levels of risk. But what we know is that they have incredibly high returns. Returns could vary from 12% to 200%. Some ICOs have had extraordinary performances. For example, OTA had a return on investment of 13,000 times. This means that if you had invested $1 when it was offered, you would have earned $13,000. We would like to know about your experience regarding the topic covered today. Share it with us in the comments, and, if you have any questions, do not hesitate to ask them. We will gladly respond. Your like would be a source of satisfaction for us, and of course, do not forget to subscribe to the channel so you don't miss the upcoming publications.